President Biden, inflation has slowed, but prices remain high. Since you took office, the price of essentials has increased. For example, a basket of groceries that cost $100 then now costs more than $120. And typical home prices have jumped more than 30%. What do you say to voters who feel they are worse off under your presidency than they were under President Trump?
We got to take a look at what I was left when I became president and what Mr. Trump left me. We had an economy that was in free fall. The economy collapsed. There were no jobs. Unemployment rate rose to 15%. It was terrible. And so what we had to do is try to put things back together again. And that's exactly what we began to do. We created 15,000 new jobs. We brought out the position where we have 800,000 new manufacturing jobs. But there's more to be done. There's more to be done. Working class people are still in trouble. That's why I'm working so hard to make sure I deal with those problems. And we're going to make sure that we reduce the price of housing. We're going to make sure we build 2 million new units. We're going to make sure we cap rents so corporate greed can't take over.
Bullshit detected. Take precaution.
In addition to that, we're in a situation where if you take a look at all that was done in his administration, he didn't do much at all. By the time he left, things were in chaos.
President Trump, over the last 8 years, under both of your administrations, the national debt soared to record highs. And according to a new nonpartisan analysis, President Trump, your administration approved $8.4 trillion in new debt, while so far, President Biden, you've approved $4.3 trillion in new debt. So, former President Trump, many of the tax cuts that you signed into law are set to expire next year. You want to extend them and go even further, you say. With the U.S. facing trillion-dollar deficits and record debt, why should top earners and corporations pay even less in taxes than they do now?
Because the tax cuts spurred the greatest economy that we've ever seen just prior to COVID. And even after COVID, it was so strong that we were able to get through COVID much better than just about any other country. But we spurred, that tax spurred. Now, when we cut the taxes, as an example, the corporate tax was cut down to 21% from 39%, plus beyond that. We took in more revenue with much less tax, and companies were bringing back trillions of dollars back into our country. The country was going like never before, and we were ready to start paying down debt. We were ready to start using the liquid gold right under our feet, the oil and gas right under our feet. We were going to have something that nobody else has had. We got hit with COVID. We did a lot to fix it. I gave him an unbelievable situation.
President Biden, I want to give you an opportunity to respond to this question about the national debt.
He had the largest national debt of any president in a 4-year period, number one. Number two, that $2 trillion tax cut benefited the very wealthy. What I'm going to do is fix the tax system.
Once a group of 5, now the Fed chair search has been apparently winnowed down to just one, and the final decision could be made as early as this weekend, so says Charlie Gasparino.
We think it's going to be Jerome Powell, the former Fed chairman, former banker, former Fed governor, former banker at the Carlyle Group. What our sources are telling us is that barring some sort of last-minute change of heart by Donald Trump, the president of the United States, who, just so you know, this is why I couch it, you never know with Donald. He's kind of a volatile guy and a volatile decision maker.
Really? I didn't know that.
Yeah, well, I don't know that. I'm in trouble enough with the Trumpkins on my Twitter feed. But in any event, he could make a change. There are 2 essential policy goals, I think, that the president wants to get out of a Fed chairman. Number one, he wants somewhat of a dove, okay? He likes the easy money, the printing of money when needed. He doesn't want to unwind the Fed balance sheet very, very fast, which might raise interest rates really high as he's looking to recover the economy. That's one.
Because Trump is, obviously, he's got real estate in his genetics, and
they
real estate guys love cheap money
okay.
and cheap borrowing.
A lot of libertarians might not like that. They think it debases the currency. They think that it sets up stock market bubbles, which it does. But be that as it may, that's what Trump wants. Now, the other thing is you have to keep in mind, since the financial crisis, a result of Dodd-Frank financial reform law, the Fed has a lot of power regulatory on banks. I mean, Fed is the uber regulator. Wasn't really like that in the past. They didn't regulate as much. Now they regulate almost everything. They're camped out in banks' offices. Another policy goal of Trump is to rein back that regulation, to let banks do more things, to make more money, to lend, make it easier for lending. Powell fits that policy goal as well.
What would he bring to the Fed that Janet Yellen hasn't brought or that John Taylor might bring?
Well, it's an interesting way you put that, because what would he bring that Janet Yellen hasn't brought? Probably nothing. He is not an economist, so he's going to be basically following the policies that were set in place and then be influenced by the staff or by anybody who's appointed as vice chair or anybody who would replace Yellen if she decides to leave the board. Remember, she can stay on if she wants. So probably you would see it as a shorthand description would be Yellen light. Taylor obviously would have more of an impact as a well-known PhD economist. He could influence the board's thinking in a lot of ways, maybe not raise interest rates immediately, but down the road have an impact there, but also on regulation, on research, on basically sort of the direction of the board going forward. But as we were just saying, Powell keeps Wall Street on the same course because he's not likely to deviate. That makes people happy, and maybe that's what Trump is thinking.
As president, there are a few decisions more important than nominating leaders of integrity and good judgment to hold trusted positions in public office. And few of those trusted positions are more important than the chairman of the Federal Reserve. Accordingly, it is my pleasure and my honor to announce my nomination of Jerome Powell to be the next chairman of the Federal Reserve. Congratulations, Jay.
Thank you, Mr. President.
If we are to sustain all of this tremendous economic progress, our economy requires sound monetary policy and prudent oversight of our banking system. That is why we need strong, sound, and steady leadership at the United States Federal Reserve. I have nominated Jay to be our next federal chairman, and so important because he will provide exactly that type of leadership.
Inside the Federal Reserve, we understand that monetary policy decisions matter for American families and communities. I strongly share that sense of mission, and I'm committed to making decisions with objectivity, based on the best available evidence, in the long-standing tradition of monetary policy independence. Mr. President, thank you again for this extraordinary opportunity to serve the American people. Thank you.
President Trump's continuing his pattern of blaming bad news on other people. So we've had some turbulence in the markets. We've had the layoffs by General Motors that were announced yesterday that so angered the White House. And the president now in an interview with the Washington Post has said, I'm doing deals and I'm not being accommodated by the Fed. They're making a mistake because I have a gut. And my gut tells me more sometime than anybody else's brain can ever tell me. I'm not even a little bit happy with my selection of Jay Powell, not even a little bit. Of course, Jay Powell is the Federal Reserve Chairman who President Trump put in that job. He's somebody who has signaled that they intend to raise interest rates again and more in 2019. The president says that that is creating economic consequences that hurt him. He's lashing out.
He doesn't like the guy.
Well, he doesn't like the policy because it's not suiting the economy. And again, if the Fed is moving, it means the economy is strong. Let's not get into this, but it seems to be common sense. If anything, Guy talked about this. Doesn't this paint the Fed further into a corner? Doesn't this paint the Fed actually into possibly having to defend the integrity of the institution?
But what is that corner now? Is that corner a hike in December plus a hawkish statement? Or can the corner can you still have a hike plus a dovish statement?
Well, something that shows that the Fed is totally independent of exterior, externalities, and at least as they relate to forces and influence, as opposed to economic data.
Right, but let's say they were intending on releasing a dovish statement after the meeting. Are they going to now switch to a hawkish statement?
I don't think so. I don't think so at all. I don't think, presidents have criticized the Fed for years. Maybe this is harsher than typical or that we're used to, but I don't think that the Federal Reserve, I don't think Jay Powell, I don't think Vice Chairman Clarita is the type of person that is going to change their mind about the economy because the president's upset.
This Fed isn't making a mistake. They're trying to clean up the mistakes of two prior Fed chairs, in my opinion. So I think they're doing everything. If, again, the greatest economy in the history of the public, not my words, the president's, if we can't stand rate hikes to get us back to some semblance of normalcy, then maybe we're in worse shape than everybody.
In many ways, I call him my MIP. Do you know what an MIP is? Most Improved Player. It's called the Most Improved Player Award. Did you ever get one of them when you were playing baseball, Corey? Good baseball player?
Certainly not.
The chairman, he's my MIP right now for the last few months. I think he's done a very good job. I disagree with him on one thing now, and that's negative rates. And only because we're paying zero. Good news, with this money you're talking about and the stimulus, we're paying zero. We're down to zero interest. That's good. But some countries and some states, rather, and some also countries you look at, but we are paying right now zero, and other countries are paying less than that, if you can believe it. They're receiving money, and I think we should be in the exact same situations.
Is that it?
No, there's more. My plan is to address inflation. It starts with a simple proposition. Respect the Fed. Respect the Fed's independence, which I have done and will continue to do. My job as president is not to not only nominate highly qualified individuals for that institution, but to give them the space they need to do their job. Chair Powell and other leaders of the Fed have noted at this moment they have a laser focus on addressing inflation, just like I am. And with a larger complement of board members now confirmed, I know we'll use those tools in monetary policy to address the rising prices for the American people. So I look forward to Chairman Powell's continued leadership at the Fed. No entity plays a more important role in navigating these challenges than the Federal Reserve. That's why today I'm nominating Jerome Powell for a second term as chair of the Federal Reserve. Jay's steady and decisive leadership helped to stabilize markets and put our economy on track to a robust recovery. And I believe Jay is the right person to see us through and finish that effort.
I want to say the country, the United States, as President Moon pointed out when we first met, the United States is doing better economically than we've ever done before. The numbers are outstanding. New numbers will be released that I think will just continue this forward march, and I think we have tremendous potential on the upside. I'm very excited about our new trade agreement, and this is a brand new agreement. This is not an old one rewritten. This is a brand new agreement, and I'm very excited about that for the United States, and I really believe it's good for both countries. But the numbers that we're doing in the United States, whether it be unemployment numbers or whether it be employment numbers, we have right now, this moment, more people working in the United States than ever before in our history. That's some number, Mike, right? And you know, it's a number that people did not expect to see. It's a number that nobody thought would happen, certainly within 2 years. We're not even up to 2 years of the administration. So we have more people working in the United States today than we've ever had. Our unemployment numbers are among the best they've ever had. For African American, it's the lowest we've ever had. For Asian American, for Hispanics, the lowest we've ever had. And we're very proud of that. And on top of that, we have many companies moving back into the United States. In most cases, it's back. They left, and now they're coming back. They all want to be where the action is. So I appreciate your kind words, but our economy is the envy right now of the world. We're the fastest growing economy in the world. Think of it, as large as we are, we're the fastest growing economy in the world, up $10 trillion. So we're very proud of that.
My inherited economy is on the brink. Now our economy is literally the envy of the world.
Please, continue.
To say he inherited like an economy that was on the brink of recession, true. Like it was a COVID pandemic. There were a lot of problems with supply chains that caused inflation, thanks to the pandemic mostly and the disruptions related to the pandemic. But what we saw in terms of price increases were not oftentimes the result of those supply chain disruptions. There was a huge problem with price gouging we saw during the beginning of President Joe Biden's term. And he didn't do much to directly address that price gouging. When you're in a time where, people are struggling to keep their jobs, when we're seeing an increase in unemployment, to have prices go up, it's really bad for most American families because that means they're being squeezed at both ends. With wages, trending stagnant since the 70s, adjusted for inflation. So wages are not being increased at the same proportion that prices are. That means people's quality of life, who are everyday working people in the United States, is going down. That's really what needs to be addressed. Yes, he did avoid a full-blown recession. We could have seen a full-blown recession if we didn't have the level of investment and, stimulus in the economy. Trump partook in some of that stimulus, some of the packages and policies to address, the recession we could have gone into, and that's great. But when we measure the success of the economy based off of GDP and job growth, it doesn't really say much for how the everyday person is doing. To understand that, we need to look at wages and prices because they work for a wage and they use those dollars that they get from their wages in their paychecks to purchase groceries, to afford housing. And people are really struggling. And so a lot of the metrics we're using to determine whether or not the economy is doing well or not are not very good. We had 334,000 people added to the pool of unemployed Americans. We have 5.7 million people who want a job, who cannot find one. That's a huge problem. To intentionally keep people unemployed has been the explicit goal of Trump and Biden with the Federal Reserve Chair Jerome Powell. So to boast about adding jobs to the economy, when you have a guy running the central bank essentially who wants to do the opposite, wants to have more people unemployed because they believe the labor market's too strong and workers are being paid too much, which is just not true. You can't really be like, hey, things are going well, record unemployment, because your guy's explicit goal is to do the opposite.
Non-farm payrolls comes in at 114,000. 114,000. Of course, that is the lightest level going back to minus 243,000, which was Dece of 2020 in the pandemic-affected months, of course. Now, if we look at the unemployment rate moved up to 4.3. Moved up to 4.3. That is the warmest it's been since October of 21. October of 21. And if we look at revisions, I should bring that out rather quickly. We see that last month's non-farm moved from 206,000 down to 179,000. We see that this weak data joins other weak data in pushing yields down. And what is notable here, and this is big time, 379 on a 10-year. Where did it close last year? At 388. It moves into the black and joins other maturities. That 2-year closed 4.25 last year. And, of course, it's trading right now at 387. And just to show you how huge these moves are, gang, 386 now in a 2-year. It closed at 438 last week. 10-year at 378, 379. It closed at 419 last week. So you could see these are historic rate drops. These are factory orders for the month of June, expecting down 3.2. We get a little extra helping of negative news, minus 3.3. That is the weakest, biggest negative month-over-month change going all the way back to the COVID-affected April of 2020. If you strip out transportation, you could see where the negative aspects came from because it goes from minus 3.3 up to 0.1%, up 0.1%. That is reversing last month's minus 0.7. It comps to up 0.5% in April. Now, if we look at the durable goods set of values here, what should jump out at us is that these are final reads. So if we look at durable good orders on the headline, it goes from minus 6.6 to minus 6.7, which means it remains at the biggest negative month-over-month change going back to April of 2020. And, of course, we know durable goods is a very volatile series, but this final read is highly negative. The astounding week-over-week change is historic. Right now at 395, we're down, get this, 43 basis points on the week. And at 383 on a 10, it's down 26 basis points on the week. 2's10 spread briefly looked like it was going to go into single digits. It's now minus 11.
The unemployment rate jumping to 4.3%. That is the highest level in nearly 3 years. And it triggered a rule created by our next guest. That's called the SOM rule. It says that if the 3-month moving average of the unemployment rate rises by 0.5 percentage point from the previous year, that signals the start of a recession. Here with more is the creator of that rule, Claudia Sahm herself, the chief economist at New Century Advisors. Claudia, it's great to have you, and thanks for joining us here. As I just described, it is a recession indicator, so help me and our audience out here. On a 1 to 10 scale, 1 being as far as possible from a recession and 10 being absolute recession territory, where would you say we stand today?
If I were to just look at the rule, so this is a pattern that's held historically, and it's been very reliable. So the way you would interpret this rule normally is we are probably about 3 months into a recession. Now, is there anything about the world right now that is normal? No. And so the SOM rule and many other indicators we've had of, say, recessions, like 2 quarters of GDP declines. We had that in 2022. We had no recession, right? Like, we really have to think about the particular context for now. So do I think we are in a recession right now? No. Do I think that the increases in the unemployment rate and the softening in the labor market is worrisome and we could end up in a recession in, say, 3 months, 6 months? Yes, I am very concerned about that. But the SOM rule is probably overplaying it right now to some extent, just because of pandemic induced and labor force. We just had a lot of shocks we're working through. So there's kind of some extra now, but we should be very concerned. So this is high up on the 10 scale, not a 10 though.
Clearly, we saw shocks to the labor market throughout the pandemic. And then even coming out of the pandemic, immigration also playing a massive role in some of that uptick that we have seen most recently.
Right. So the recession indicator, it looks at changes in the unemployment rate, right? Because as a country, we've gone into recessions with really low unemployment rates and really high unemployment rates. So it's looking at changes, looking at this momentum. The once you get enough going, you're in a recession. Okay, so there are things that have happened that have really moved around that change in unemployment. We had the labor shortages earlier on when people dropped out of the labor force because of the pandemic. That pushed the unemployment rate down really low. So we're comparing to something really low. And then in recent years, we've had a big surge in immigration and other people coming in from the sidelines, the labor force. It takes time to find a job if you're coming in from the sidelines. That does push up the unemployment rate. As long as it does that temporarily, right? And then we get people working, that's great. But so like that aspect of these big changes in the labor force that were not only big, they were fast, has just made an indicator like this that's trying to figure out the momentum more challenging than we have seen in any of the historical record that the rule was created off of. What we could see is Fed officials coming out and as they give their guidance or communication, we could have them really talk up, we're willing to do whatever it takes to make sure we don't see more weakness. And I think that could give some support, and yet, they want to be measured. They don't want to go into panic mode. I think that's appropriate. And yet, just even 2 days ago, this is not the labor report that Jay Powell thought he was going to see. They were very clear. They don't want to see more weakening. We saw more weakening.
Wall Street set to open up sharply lower, extending Friday's sell-off. That was sparked by the weaker-than-expected jobs report, raising worries the economy may be headed for a recession, and the Fed could have waited too long to start cutting interest rates. The Dow dropping more than 600 points on Friday, its worst day since May. The S&P had its worst week since April. The selling spreading to Asia overnight. Japan's Nikkei index tumbling 12%, its worst day since the stock market crashed back in October of '87. European markets are also red across the board. Half of credit card holders are carrying debt month to month, the highest figure in more than 4 years. A new bank rate survey finds 60% of those with credit card debt have been in that state for at least a year. More than a third say inflation has been made worse, made their burden worse, while a third cite high interest rates.
We are covering a global market sell-off this morning. This is underway right now. Now, the Nasdaq entered correction territory on Friday, but we have seen a worsening in the futures market of the major indices since we have been on the air since 6 a.m. Eastern time. We are barely off of session lows, but the Dow Jones Industrial is now down 1,250 points. That is a loss of more than 3%. The Nasdaq is down 1,067. That is a loss of 5 3/4%, and the S&P S&P is down 231. That is a loss of more than 4.25%.
It's getting ugly real fast out there. So, I mean, look, right now, the volatility index, or the fear gauge, which is a measure of how afraid investors are right now, it's at a 65. And just to put that in perspective, if we go back to March of 2020, when the pandemic was full swing and people were locked up in their houses, it was 53. It's 65 right now. You go back to March of 2009, when we had the banking crisis, it was 44. We're at a 65 right now. Investors are incredibly scared. And I have to tell you, this cannot just be due to Friday's payroll report, because on Friday, the market was down about 2%. So there's more going on than just that. I think the other two issues are, number one, Warren Buffett unloaded half of his Apple position. That's a guy who's buy and hold forever. All of a sudden, he's, maybe he doesn't have a high conviction on Apple going forward. And then, obviously, the increasing probability of a full-scale war in the Middle East. You put those three things together, and it's an ugly situation in the markets today.
And Liz, yeah, I mean, the initial caveat to this was that jobs report last Friday, and we saw the market sell off on Friday. Fears of a recession bring over the weekend. But to Mark's point, you have a potential strike on Israel by Iran, as well as we're in election year. I mean, there's a lot of things that the recession talk is really what.
Look, I think on the economy, the jobs report was pretty poor, but it really kind of brought to a head a lot of concerns about credit card delinquency spiking, consumer sentiment being in the toilet again and perpetually over the last several months. The fact that consumer spending is dwindling. I just think there are an awful lot of reasons people were concerned about a possible slowdown in the economy, and now there is actual evidence that it's happening. I also think, and maybe it's just me, the country feels completely leaderless. I mean, who is speaking out? Who is talking to the American people? Joe Biden can't. It really appears like every time he tries to do that, it's kind of a catastrophe. And Kamala Harris has not stepped up. So here we are, as you point out, Cheryl, facing increased possibility of actual war now in the Middle East, been talked about for months, but now it seems to be at a breaking point, and there is no one talking to the American people. I think that's very unnerving.
6.5 cuts are now priced in by the end of January. That is incredible. And that only happens if you are expecting a recession. The Fed's not doing that to be nice. They're not doing that to lower mortgage rates so people can buy a house. That is trouble. That spells trouble.
Joining us now is Jeremy Siegel, Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business, Chief Economist at Wisdom Tree. Jeremy, I hate, you probably aren't happy to say I told you so either, given what we're witnessing. But you thought the Fed was staying once again, for the second time, staying at the party too long and too restrictive.
Absolutely. And this may surprise people. I'm calling for a 75 basis point emergency cut in the Fed funds rate, with another 75 basis point cut indicated for next month at the September meeting. And that's minimum. The Fed funds rate right now should be somewhere between 3.5% and 4%. Let me give you very simple logic of my position here. At the June meeting, the Fed has said that the long run Fed funds rate, when inflation reached 2% and unemployment has come up to 4.2%, should be 2.8. That's the normal. 2.8 is the normal Fed funds rate. Well, on Friday, we blew across the employment number. We're at 4.3. That even argues for a lower one. Now, as far as inflation, we're at 2.5%. We've gone down 90% towards the target on the inflation rate. We've overshot the target on the employment. Those are the two targets explicitly mentioned by the Federal Reserve. All right. And how much have we moved the Fed funds rate? 0. That makes absolutely no sense whatsoever. The market knows so much better than the Fed. So, I mean, they've got to respond. Listen, their own stated normal Fed funds rate when we hit targets is 2.8. They're basically at the target. And there's a lag in monetary policy.
Listen, Jeremy, let's say they do that.
Take a look at the Taylor rule. Take a look at any of the rules right now. They're all 150 basis points lower.
Let's say that Jay Powell came out and before September, an emergency meeting comes out and he lowers the rate. Does the market rip or does the market say, oh, my goodness, it's worse than we even thought?
It rips. It welcomes it. Absolutely. Because it's so far behind the curve right now. You take a look at the data. It is not at all comforting. I mean, the hiring employment part of the ISM that we got was just absolutely horrible. I mean, forget about the SOM rules and all that are predicting recession. I'm looking at the Fed's own data and the Fed's own written policy, 2.8 when we are at and near the target. They overblew one target and they're 90% towards the other target. If they're going to be as slow on the way down as they were on the way up, which, by the way, was the worst policy error in 50 years, then we're not in for a good time with this economy.
The Bidenomics continue. Vice President Harris.
You know what area called? The economy is going to continue with all those legislation and taxes working. In case you haven't noticed, it's working.
How much does it bother you that Vice President Harris might soon, for political reasons, start to distance herself from your economic
She's not
plan?
going to.
Is there a Venn diagram for this?